I think my competitive advantage is very simple. It's curiosity. When somebody says, here's the way the world works, I ask, oh, are we sure? Have we tested this? And so when neo-Keynesians tell me that stimulus stimulates, I will take a deep dive and say, does it really?
Welcome everyone to a new episode of The Blunt Dollar. Today's guest is Rob Arnott, founder and chairman of Research Affiliates and one of the most original minds in modern investing. Over the past 4 decades, Rob has published more than 150 articles, edited the Financial Analyst Journal, and pioneered portfolio concepts that went from heretical to mainstream.
Artificial intelligence will accelerate it yet again. What used to happen in millennia will happen in decades, perhaps even years. The future evolution of humankind may be that AI supplants humankind. It may be that AI and humankind merge.
This is The Blunt Dollar with Ignacio Ramirez. Quick disclaimer, the views and opinions expressed in this podcast are those of the speakers and do not constitute financial investment or legal advice. This content is for informational and educational purposes only and should not be relied upon as a substitute for professional advice. Always do your own research and consult a qualified advisor before making any financial decisions. All investments involve risk, including the potential loss of capital. And now, let's get started with the episode. Welcome everyone to a new episode of The Blunt Dollar. Today's guest is Rob Arnott, founder and chairman of Research Affiliates and one of the most original minds in modern investing. Over the past 4 decades, Rob has published more than 150 articles, edited the Financial Analyst Journal, and pioneered portfolio concepts that went from heretical to mainstream, including fundamental indexing, global tactical asset allocation, and tax-aware equity strategies. At Research Affiliates, he's built a powerhouse of innovation with over $160 billion in assets managed worldwide using their models. He's a prolific writer, a contrarian by nature, as you'll see, and someone who's unafraid to challenge orthodoxy, whether it's efficient markets, indexing, or government stimulus. In this episode, we get into what it really takes to build something independent in a conformist industry, why discomfort is often a sign you're on the right track, how to stay curious over decades, and what the markets have taught him about time, humility, and legacy. Rob, it's an absolute pleasure to have you on the show. Welcome to The Blunt Dollar.
Thank you so much. Real privilege to be here.
So I always like to start my interviews asking the same question. Can you tell us a little bit about your day-to-day? What is it that you're doing exactly at Research Affiliates?
Oh, we are focused on product innovation. We're focused on developing new ideas. And the name of the company is our corporate mission, Research Affiliates. We do research, we do product development, product innovation, and we affiliate with distribution powerhouses to make these ideas available to the marketplace. In this way, by outsourcing distribution, by focusing on what we're good at and not diluting it by trying to be good at everything, we have the ability to stay focused on research. And so 70 employees, roughly half of them are involved in R&D. And in the past, when I was running First Quadrant, we had 130 people and we had 12 in research, less than 10%. And so here it's closer to 50%, which is fun.
Wow. Tons of smart people, I'm sure, too. So we're going to be digging a little bit more about what you're doing at Research Affiliates. But before that, I'd like to talk about you and hear a bit about your journey. Because from what I read, you didn't really come into finance through the usual doors. You studied applied math and computer science and had early exposure to neural networks back in the 80s. And I believe you even once considered a career in astrophysics. So you've joked in the past that your math skills weren't strong enough for physics, but they were more than enough for investing. Tell us a bit, what made you choose finance and what kept you interested in across all of these years?
Well, when I was in high school, I was fascinated by the stock market, and I was also fascinated by the heavens. And um, I attended a program called the Summer Science Program back just before my senior year in high school. I was
Hmm.
15 at the time. And it's a program that still exists. And it's just an awesome deep dive into science. And for the first time in my life, I was surrounded by people who were as good at math as me, and in some cases, distinctly better. It was an astronomy and physics program. And basically, you go through a year of college level astronomy, a year of college level physics, and a year of college level chemistry jammed into 6 weeks. So it was a very intensive program. It was a hoot. Um, and it was there that I began to realize that there were people who could run circles around me on advanced math. And when I went to college, I began to shift, and by the second year of college, had decided I'm going to pursue investment management.
Hmm.
I find it fascinating, and it's a field in which scientific method simply isn't used back then. So I was a quant before the label quant was invented. Um, and it's been just an absolute thrill. It has basically, I think my competitive advantage is very simple. It's curiosity. Uh, when somebody says, here's the way the world works, I ask, oh, are we sure? Have we tested this? And so when neo Keynesians tell me that stimulus stimulates, I will take a deep dive and say, does it really? And that led to a recent paper, Stimulus Doesn't Stimulate. And a longer version on SSRN, does fiscal stimulus stimulate? And basically, we demonstrate that it doesn't. It might have a short-term impact over a
Hmm.
course of months, but not even a year. And so the whole notion that spending massive sums by the government is going to ignite the private sector. Why don't you leave the money in the private sector to ignite itself? And so, same thing for the markets. The efficient market hypothesis was early in my career was just gaining traction, and by
Hmm.
the 1990s had completely taken over the academic community. And I just kept asking, okay, that's a hypothesis. It's called a hypothesis. Um, uh, does it have legitimacy? And very quickly found two important things. One, uh, market efficiency is a myth. And two, market inefficiencies, once discovered, can be arbitraged away. So it's a moving target. And the fact that it's a moving target makes it look more efficient than it is. Um, Fun stuff.
Wow. Well, one thing's for sure, you clearly seem to be incredibly passionate about the finance industry in general and all these theoretical studies. So that definitely permeates when we read some of your materials and when you hear you talk. And by the way, I haven't read your paper of whether financial stimulus really stimulates or not, but I'm really looking forward to reading. Where can we find it actually?
You can find it on SSRN. If you go on SSRN and just type Arnott stimulus,
All right,
it'll take you straight to the paper.
sounds good.
And of
Um,
course, SSRN is open architecture. So when we write papers, if they're of reasonably serious academic quality, we'll post them on SSRN. And then we'll consider submitting them. So that particular paper is under consideration at a journal.
mhm.
And if the journal accepts it, we will pull it down from SSRN, publish it in the journal, edit it according to what the referees find wrong with the paper, and uh, take it from there.
And of course, SSRN is freely available to
It is.
everyone.
It's open
So
architecture. It's
exactly,
it's yeah. It's a wonderful website.
that's absolutely true. Um, Now, taking a step back once again, you've held senior roles at Salomon and First Quadrant, as you were saying before. I
Mhm.
was wondering, like, what do you remember from those years? What did those early experiences teach you?
Well, my first job was with the Boston company, which was the owner of Boston Safe Deposit and Trust Bank. And it's funny, when I got out of college, uh, it was old fashioned. There were no, you couldn't email your resume to people. You had to um, mail it out. Xerox machines didn't really exist. And so I had to type my resume and I sent it to about 100 uh, uh, companies. So type it 100 times, mail it to 100 places. And I got four interviews and four job offers. And I took the one that offered the least pay. Why? Because I told each of the four I want to do independent research. And it may or may not lead to business opportunities for you, but it's important to me. And Boston Company said, okay, you can take a day a week and do whatever research you want. You can use our computers and our databases
Nice.
and do that research, and we'll pay you for the other 4 days. So I thought, wow, that's a great deal. Um, and From there, I went to Solomon Brothers. Well, I went to TSA Capital Management and then Solomon Brothers. Solomon Brothers, I was 32 and I was global equity strategist, which meant I could say anything that I liked about equity strategy as long as it agreed with Bob Solomon on equities and Henry Kaufman on bonds. So those are the two constraints. I had to agree with them on stocks and on bonds, but other than that, I could say anything. Uh,
Did they agree between them? That's the question.
no,
Not necessarily. So it was a tough job.
yeah, but I met a lot of really, really smart people. I learned very quickly that I was horrible at office politics and had uh, no clue how to function in a sharp elbows culture. Um, but I learned a lot and I had great fun. I was then recruited to First Quadrant to turn what was the asset manager for Crum and Forster Insurance into a company that offered product outside to the
Mhm.
outside world. And that turned into a 16-year stint. So that was uh, basically, I was brought in as CIO fairly early on, became CEO and then chairman. And uh, it's it was a wonderful experience in many ways. I built it up to 30 billion AUM by the year 2000, and uh, we were owned by a company called Affiliated Managers Group. I did not like their business model, which prompted me to decide to launch research affiliates. It was kind of funny. Uh, I launched research affiliates, and I told them I would be leaving sometime in the next 3 to 5 years. If they wanted me to leave immediately, that's fine with me. But I would prefer a transition to
Mhm.
transition the client relationships to the rest of the First Quadrant leadership team. And I said, and by the way, I'm starting my own business. And they said, you can't do that. Your contract calls for you to work full time. I pointed out that I can work 40 hours for them and 40 hours for me, and that's what I was going to do. So anyway, I launched Research Affiliates, and 2 years after launching Research Affiliates, I left First Quadrant. So there was a 2-year transition.
Mhm.
One of the things I was really proud of is we lost 0 clients at First Quadrant, not one, during that transition. And so that was I felt I'd done the right thing and done it the right way.
Wow.
So it's been like any career. It's had its roller coaster moments, and when things go haywire, that's when you learn fastest. And uh, tough times are the crucible that shape us.
Mhm. So tell me a bit more about research affiliates, because it's not just an asset management firm. It's become a kind of a research engine that shaped how institutions invest around the world. When you thought about it, what problem were you trying to solve, and why did you go for it? Was it more about the intellectual freedom? Was it a market opportunity? Were you bored in your previous job? A mix of everything.
I've never actually been bored, um, but uh, I I had dinner with Jack Bogle when I was thinking of launching research affiliates. He launched Vanguard Group when he was 48. I launched research affiliates when I was 48.
Mhm.
And I wanted to tap into his thinking. What was it like to start a business from scratch when you're in your late 40s? And we had a delightful conversation. He was, in many ways, a I would describe him as a distant mentor. That is to say, I never worked with him, but I admired him and found his insights to be fascinating and uh, inspiring.
Mhm.
But in any event, I didn't start Research Affiliates saying, I'm going to launch a global TAA strategy that is centered on assets outside of mainstream stocks and bonds, the all asset fund. I didn't go into it saying I'm going to invent fundamental index. I went into it saying there's going to be some interesting puzzles to solve and opportunities to build product. Let's see where this leads. So it
Mhm.
was not any particular insight into this is what I'm going to do. What I was going to do was research. Now, remember that I overlapped with first quadrant for 2 years. I wanted to avoid conflicts of interest. So um, I'd actually been invited by PIMCO to come in and share my views on global asset allocation with them in December of 2001. And at the end of my presentation, I went up to Bill Gross and said, are there opportunities for us to work together? And he said, uh, go talk to Brent Harris. He's the chairman of PIMCO Funds, and we're working on something that might be right up your alley. Well, it turns out they were gearing up to launch the all asset fund, and they were debating between do we do it in house, because they'd always done everything in house, and which would mean they doubled down on whatever are their um, market views.
Mhm.
Within their funds, they would represent their market views, and in the asset allocation, they would represent their market views. Or do we partner with an outsider to do the asset allocation decisions? So we seek to beat our benchmarks in the funds, and we get an independent view of which funds, which asset classes should be focused on. Um, I met with Brent Harris. It was kind of funny. Our paths next crossed in Tokyo, so we had breakfast at the Hotel Akura, and wide ranging conversation. And he said, "I think we'd like to do it with you."
Wow.
Um, and then he said, "What would you want to get paid?" And I said, well, I don't want to come work for you. I'm going to be starting my own business. So I would want an asset based fee. And so why don't I write down what I would want and you write down what you'd be comfortable paying, and we'll exchange pieces of paper so we don't tip our hand to and get into a bid ask thing. And lo and behold, we both written the number 20 on the piece of paper, 20 basis points. So to avoid a conflict of interest, I went back to my colleagues at First Quadrant and I said, would you like to do a global asset allocation? Global asset allocation was the core business of First Quadrant. would you like to do a global asset allocation business with PIMCO, which will require building models for tips, for commodities, for REITs and other asset classes. So instead of just stocks, bonds, and currency, you're going to have to develop expertise in the whole spectrum of asset classes. And they said, well, what would it pay? And I said, 20 basis points. And they said, how big are the assets? And I said, it's starting a new fund. They're going to seed it with 3 million. So that's $6,000 of annual revenues. And they said, forget it, not interested. And so that gave me the green light to do it with my own new company. And so, ironically, the fact that I had to start the business while carefully avoiding conflicts of interest is what led to the business model where we develop products and partner with distribution partners. And that's been a terrific business model because it really frees our hand to do what we want to do.
Wow. What a story. I love it. I love it. I think it's also particularly interesting because this was the early 2000s, right?
Correct.
So I know you're pretty big in indexing, and at the time, names like Vanguard and MSCI were dominating the whole thing. So how
Mhm.
did you carve out space for a new kind of indexing philosophy when pretty much the category was already owned by giants? Hey there, quick favor to ask. If you enjoy the blunt dollar, the unfiltered takes, the stories, and the laughs, the easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
It was owned by giants. It's still owned by giants, the same giants, in fact. And we developed the idea of fundamental index in 2003. Again, I was still with First Quadrant, so I still had conflict of interest issues. And I brought it to the team at First Quadrant and said, I'm creating a new index, calling it fundamental index.
Can you explain for our audience what do you refer with fundamental indexing, broadly
Sure,
speaking?
sure. A guy named George Kane, who was a dear friend and was, in fact, my first client at First Quadrant and my first client at TSA Capital Management. He and I were lifelong friends. Um, and he was on the board of the New York State Pension. And he was just horrified that they put large chunks of money into an index fund and you had 4% of the portfolio in a little tiny company called Cisco. 4% of the S&P 500, 4% of the portfolio in March of 2000 in a company that fell 90% in the bear market. And he said, there's got to be a better way. Why on earth would you put 4% of your portfolio in a little company tacitly betting that it's going to become an enormous giant, one of the second largest business in the world because it was the second largest market cap stock in the world. How plausible was that? And uh, I had long thought it made just as much sense to index based on a company's revenues or book value as on its market cap. And if you do it on, let's say, revenues, you're going to have uh, growth stocks reweighted down to their economic footprint, out of favor unloved value stocks reweighted up to theirs. So you will have a value tilt, but much more important than that, you'll be anchoring on something that does not correlate with whether the stock is over or undervalued. The price correlates with whether it's over or undervalued. So if you weight by price, weight by market cap, you will overweight the overvalued, you will underweight the undervalued, no exceptions. And the indexers always had been hearing that criticism since the dawn of indexes. S&P was created in 1957, and they'd heard the criticism for 50 years. The natural response was very simple. Yes, we overweight the overvalued, we underweight the undervalued. So what? Unless you can tell me which stock is over or undervalued, you aren't saying anything useful. And the stock that's overvalued is not necessarily the high multiple stock. You can have a low multiple stock that's overvalued because its business prospects are dismal. And this company may have brilliant prospects and actually be underpriced. And so that pushback was very powerful. But we recognized that with fundamental index, you were breaking the link with price. And so an overvalued stock could be over or underweight instead of always being overweight relative to fair value weight. And so the errors would cancel. Jack Trainer wrote a paper in 2005. Jack Trainer was one of the early editors of the Financial Analyst Journal, and he was one of the co-inventors of capital asset pricing model. Absolutely brilliant man. And in 2005, he wrote a paper, Why Valuation Indifferent Indexing Works. And he pointed this out, and he went through the mathematics and showed that if you weight a portfolio in a fashion that ignores price and therefore randomizes the over and undervalued errors, that you will add value. And he showed how much value you'd add. It correlates to the magnitude of errors made by the market in pricing assets times the speed at which it identifies and corrects those errors. And he estimated that valuation indifferent indexing would win by about 2% per annum.
Okay.
Well, that's in fact been exactly the case. Rafi has style adjusted has beat the market by 2% per annum. Now, style adjusted means you got to compare it with value indexes. But anyway, the genesis for fundamental index was this conversation. There's got to be a better way. And lo and behold, George was an early client of fundamental index. One of the beauties of fundamental index is if a stock soars and its fundamentals don't, you're going to trim it. If it tanks and the fundamentals don't, you're going to top it up. So you're constantly contra-trading against the market's price movements. The market's always changing its mind on what a company is worth, and you're contra-trading against that. When the market pushes a price up because it sees something wonderful coming and it's right, wonderful things happen, you'll have contra-traded, you'll have reduced the allocation, but that's okay because even with the price being up, the price reflects those expectations. So the stock still now has to beat lofty expectations in order to make further progress. So the contra-trading wins, adds value when the market's wrong, when the market pushes something up and then says, oops, got that wrong, got to trim it. And so we'll have already sold before the price drops. But fundamental index has been central to our success and has been a crucial catalyst in all of our thinking about indexes. I'm working on a monograph for the CFA Research Foundation on the active side of indexing. And people think of index funds as passive. Mostly they are, but if they have 5% turnover per annum, which is fairly typical, that means they're 95% passive and 5% active. And what does that active look like? You're adding stocks to the index when they've soared in market value, when they loft into the top 1,000 or the top 500 stocks by market cap. So you're going to be buying stocks when the momentum has been stupendous and when they're trading at massive premium valuation multiples.
You let go.
And those will replace deep value stocks wildly out of favor that have tumbled, horrible momentum, dirt cheap.
Mm.
And in the last half dozen years, the stocks added to the S&P, for instance, have been trading at roughly 6 times the valuation multiples of the stocks they replace. It's huge. So I like to joke that the active side of indexing looks like Kathy Wood on steroids. Um, it's trading um, phenomenal growth stories in favor of ditching deeply out of favor value stories. Well, simple fact is a lot of those phenomenal growth stories turn out not to be all that phenomenal. So there's a lot of flip flops. Over a third of all stocks that are added to the S&P 500 or the Russell 1000 um, are removed from the index within 5 years.
Oh, wow. I didn't
One
know
out of
that
three
stat.
stocks that are added are flip flops: buy high, sell low, and that insight came out of our work on fundamental index.
I didn't know that stat. I'm gonna definitely keep that. 1/3 of the stocks that are being added to the S&P are out by 5 years. Wow.
Yeah.
Yeah, that's definitely shocking, I'd say. And I like the Kathy Wood on steroids analogy. Wow.
So for every Tesla or Nvidia that comes along that turns out to achieve great successes after being added,
Mm,
there's going to be a half dozen or more that don't live up to expectations and are kicked back out.
yeah.
It's uh, patience can improve index fund returns. We did a paper back in 2018, buy high, sell low with index funds, in which we showed that if when the S&P decides to um, add stock A and sell stock B, if you simply write that trade on a post-it note, stick it on your fridge, and then a year later take it down and do the trade. So you're doing it a year behind the curve. You add 20 basis points per annum to your returns. You
Not
do
bad.
20 basis points better than the S&P by not trading when the S&P trades, by waiting for a year so that you're not buying at frothy
Mhm.
high momentum and selling at deep discount, dreadful momentum.
Mm, interesting. Wow. Which doesn't mean you won't make money, but it means that you're underperforming. Um, wow. You and while you were talking, you touched upon a word that I had in my notes that I wanted to discuss with you, which is the punctuality. Like I want to talk about the price of being early, the price of being late. Um, Actually, the price of being early more than being late. You said in the past that it's not fun being early because it's very lonely, and as we know, often it's very unrewarded, at least at first.
Yeah.
So I
Yeah.
wanted to ask you about an example of an idea or even a recommendation you made where you were too early, and yeah, what happened there, and if it was dismissed at first but later proved right. Yeah, if you could share a story along those lines, it would be really interesting.
Sure. Well, I was referring to being early in an investment choice, not in an investment strategy idea. Although the same can apply there too. What I was referring to is anything that is a bargain got to become a bargain by inflicting pain and losses. So, uh, if you have a contrarian investment process, and if that process buys what's unloved and out of favor and sells what's frothy and expensive, what's the likelihood that you're going to be buying that stock at the bottom and have it take off right away? Very, very, very slim. Chances are you'll miss the bottom,
Mhm.
and chances are it's things will get worse before they get better. Pretty high odds on that. So what you buy makes you look and feel stupid until the turn happens. So with contrarian investing, you just have to have the courage and staying power to if you buy a bargain, and if it gets cheaper, to buy a little more. Average in, average in, and get your average
Dollar
cost
cost average.
basis. Yeah, get your cost basis down, and when the turn happens, you have the chance to win big. So fundamental index, for example, does this. If the market's paying a small premium for growth, we reduce the growth stocks, boost the value stocks, and we take on a small value tilt. If the market's paying an enormous premium for growth, we take on an enormous value tilt. Mm-hmm. So think of the growth value cycle. Value wins, it loses, it wins, it loses. Over very long periods of time, it probably wins more than it loses. Finance theory was confident about that last century, less so this century, but you probably win more than you lose. Well, what if with a value strategy, when you win, you lighten your value tilt? Then if value turns against you, you lose less. And then you increase your value tilt. You turn that sawtooth pattern into a ratcheting effect. And that's the essence of fundamental index. So with fundamental index, one thing I've seen again and again and again is when it goes against us, we know we're going to boost our bets. We're going to average in. We're going to buy more of what's out of favor so that when it comes back, you win back the shortfall astonishingly fast. Uh-huh. I've seen this happen again and again and again. And so being early requires courage of conviction and patience. Mm-hmm. And you have to be willing to look and feel stupid. This is the essence of contrarian investing. John Maynard Keynes wrote about this with the decisions of committees, that decisions of committees were inherently comfort seeking and therefore inherently wrong. And if you propose a view that's out of mainstream, uh, if you're right, you'll be perceived as having been lucky. If you're wrong, the committee will have no mercy. Yeah, the committee will have no mercy. So, I mean, I'm not a Keynesian. I think he got a lot of things wrong, but he was a brilliant investor. He understood human dynamics really, really well.
Wow. Gosh, yeah, plenty of things to think about. But I want to take a different angle now, going back to your contrarian nature, because we touched it upon a little bit, but then we diverged. You said it before in the conversation that you like to challenge things, from Keynesian stimulus, with your paper, that you were alluding to euphoric AI narratives from what I've seen online.
Mhm.
When you go against something that is widely accepted, which in some way, ties to what we were saying before of being early, like the belief that stimulus drives growth. How do you prepare for the blowback? Hey there, quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
Early in my career, I didn't. And I was always stunned that people were so angry at having conventional wisdom challenged. It always surprised me. It wasn't until I was, I guess, in my 40s that I realized, oh, when you challenge conventional wisdom, you're challenging the core foundation of many people's careers. They've built a career on an idea that you've just demonstrated is wrong. Of course, they're angry. I wrote a paper in 2000 called The Death of the Risk Premium, in which I showed that TIPS had a yield of 4.3, S&P had a yield of 1.1. TIPS had income and principal rise with CPI. Stocks had income that rises with CPI plus 1 or 2% historically. So tacitly, that meant that the earnings and dividends on stocks had to rise at least 3.2% over and above inflation per annum for stocks just to match dull, simple TIPS. And I wrote Death of the Risk Premium saying this was not plausible and your starting point valuations matter and the risk premium at the moment is dead. There will be no risk premium for the long-term equity investor from these market levels. I pointed out in my closing paragraph, like the Phoenix, the risk premium can come back from the dead, but the process of coming back from the dead is revaluation downward to levels that produce a higher yield, or for bonds to perform brilliantly so that their yield comes down. And if you have that happen, the risk premium can come back to life. And about 4 years later, I was at the Q conference and I was chatting with a guy about finance theory and whatnot. And I said, uh, how's life? And at one point he paused and he said, by the way, I should tell you, I no longer hate you. And I thought, what? I had no idea you hated me. Why did you hate me and why do you not hate me now? And he said, well, you wrote Death of the Risk Premium. And I'd built my career on the notion of a positive risk premium. And I was livid that you would suggest that the risk premium didn't exist. And I said, so why don't you hate me now? And he said, you were right.
And hence you became friends.
uh, well, we didn't see each other much after that, but it was eye-opening to realize, okay, people can get really angry if you challenge their thinking. The funny thing about contrarian investing is I'm not inherently a contrarian. I don't look for things to argue with, things to disagree about. I look to learn.
Yeah, it's
And so it comes from curiosity, not from just a contrary nature. Um, uh, if somebody says, "Here's how the world works," I'll ask the question, "Has this been tested?" And if it hasn't been, I'll test it. And if it turns out to be right, great. Okay. Conventional wisdom is often right. And I get a little paper out of it that's not terribly surprising. And if it's wrong, I get a paper out of it that um, makes people angry and that challenges conventional wisdom. But it's all from a perspective of curiosity, not just inherent contrarian
yeah, it's
nature.
not about being provocative for the sake of it, but really, as you were
Yeah,
saying, out of
exactly.
curiosity. Um, we're getting close to the end of the conversation. I have a couple more questions. One is about time. To me, patience seems like one of the few true edges left in markets. I think your analogy of the post-it on the fridge kind of encapsulates it very well. Why is time horizon such a powerful and, in my view, often underrated tool for investors?
Well, the most pervasive error um, uh, investors make, is performance chasing. Whatever is newly expensive got there by creating great joy and great profit. And um, so performance chasing involves driving with your eyes in the rearview mirror. It involves assuming that the past is prologue and is predictive of the future. Um, Mean reversion. Harry Markowitz at one of our conferences once said there are only two free lunches in investing. One is diversification, the other is mean reversion. And mean reversion requires going against the grain, requires investing where others don't want to. An early mentor, a guy named Bob Lovell, used to say, uh, any strategy or investment that's easy to sell, don't buy it.
Hmm.
He was an instinctive contrarian. He came across as an ornery cuss, but he was actually absolutely delightful guy. But he was an instinctive contrarian. He didn't need computer models to make contrarian choices, and his investment results were brilliant. But um, uh, when you are contrarian, you must be patient. Uh, when you are trend following, you must not be overly patient because you're buying what's performed brilliantly. And when mean reversion comes, it can be pretty vicious. Cisco, um, soaring in the .com bubble and then crashing 90%. NVIDIA, brilliant company, visionary leadership, extraordinary product,
Mhm.
but it's priced to reflect that the expectation that it will continue to be just as brilliant, just as path breaking. And disruptors get disrupted. People forget that. So time matters in the sense that if you're contrarian, you must be patient. If you are trend following, you must have a sell discipline and you must not be unduly patient. So time cuts both ways.
Mhm. Very interesting. Um, Listening to you, I noticed something is that you use a lot of stories and analogies, which
Yeah.
I think it's pretty cool. Um, like when you were saying, it's like Kathy Wood on steroids. Um, and it brings me to the topic of storytelling, which is one of the areas where I'm trying to get better at the moment. How do you think about storytelling in investing, and when does a good story help move the data or the needle?
Um, I think one of my competitive advantages is that I can take complex ideas and convey them to a non-quant audience, and part of that is storytelling.
Mm,
Uh, it's I guess I think visually, and I think um, um, in nonlinear ways, and I have fun with stories. And uh, if you seek to make your ideas fun, um, that makes them more accessible. That engages your audience,
mhm,
and people. It won't be a situation of eyes glazing over and interest disappearing.
mhm,
so so it, it's I guess just the way I think tends to be in stories, images, uh, pictures. A picture's worth 1,000 words, or so they say, unless the picture is just a really stupid, too simple picture. But
mhm.
most of them tell a story and can be wonderfully communicative.
Well, yeah, I fully agree with everything you said. Um, I read a paper. I need to find this paper for you, um, where they were sharing data with two different focus groups, and they were telling a story to one of the two groups, and then they were asking about the information that they were sharing with them a couple days later, and those that received the information with a story had a significantly higher recall rate. And I think it's just the way our brains are wired. Like for
It is.
centuries, we were, we didn't have internet, we didn't have computers, phones, and so on, and people were sharing knowledge via stories, and we naturally respond to them. Um,
On the African veldt, we didn't think in terms of differential equations. We thought in terms of pictures.
exactly. Okay, so two very fast last questions. One is, of course, we cannot talk about finance in 2025 without talking about AI. Um,
Absolutely.
you've spoken recently about how generative AI shocked you with its insight, even calling a ChatGPT response gobsmacking. What excites you or worries you the most about AI?
Well, what excites me is, firstly, it's the real deal. Um, uh, the artificial generative uh, intelligence is around the corner. Um, Computers that seem as intelligent as a PhD are already here. Computers that are as intelligent as a PhD are right around the corner. Might be 5 years, might be 10 years, might be 2 years. I don't know. Anyway, it is the real deal. It, my chief executive officer, a guy named Chris Brightman, um, asked ChatGPT to describe AI, how AI fits in the context of human evolution. And I'll send it to you so you can post it along with the link for this because it's incredibly powerful. Um, uh, if somebody told me it was the ruminations of a dual PhD in anthropology and philosophy, I would have believed them.
Hmm.
Uh, the answer was nuanced, crystal clear, and a little scary. Towards the end of it, it talked about how evolution proceeded millennium by millennium, and then intelligence arrived. And with intelligence, it accelerated. And intelligence led to the Industrial Revolution, and it accelerated again. And artificial intelligence will accelerate it yet again. What used to happen in millennia will happen in decades,
Mm.
uh, perhaps even years. It closed by saying the future of humankind, the future evolution of humankind may be that AI supplants humankind. It may be that AI and humankind merge. And the closing sentence was the wonderful thing about this is for the first time in evolutionary history, we get to decide. My immediate thought was, okay, who's we?
Humanity as a whole.
Well, that's one answer. Might have been AI. We, AI. Anyway, I thought it was absolutely fascinating. It you can worry about it, and does it represent a threat, even an existential threat? Yeah. Um, should we stop it? Good luck on that.
Too late.
That's not going to happen. So the thing is to try to work with it and use it as an extraordinarily powerful tool. We will see a revolution in human productivity, and
100%.
that's going to be just dazzling, and it'll happen um, uh, slower than the AI advocates tell us, but faster than any industrial revolution we've ever seen. The world 10 years from now will be very different from today. When they said with the internet, the world in the next 5 years will be radically different. No, that wasn't true. It took longer than that because humankind resists change. But 25 years on, it's a very different world now from the year 2000. And it'll be a very different world in 2035 from 2025. So I think AI is the real deal. I also think in the markets it's a bubble because disruptors get disrupted. There's no guarantee that OpenAI will be the dominant AI player in 5 years, let alone 10, or that will be the dominant search engine in 3 years, let alone five.
Mm.
Uh, I abandoned Google in favor of Perplexity a while back, and I love it. I don't get pop-up ads. I don't get sponsored websites that I have to scroll past to get anything useful. I just get 3 or 4 websites, relevant websites, and a text description of the answer to my question.
Yeah.
And it's so powerful. It's so useful. Um, I even use it to review my papers. I was editor of the Financial Analyst Journal for 4 years back in the early 2000s and saw hundreds of papers come in, sent them to referees to review the papers and write reports on what was good and what was bad about them. When I give a paper to AI and say, tell me 5 things that are wrong with this paper and tell me um, what citations I may have overlooked in writing the paper. It'll write 3 to 5 page review of the paper that is better than anything I ever saw. Anything I ever saw as editor of the FAJ.
Yeah.
Um, and it'll give a list of citations, and 2 or 3 of them I'll think, gosh, why didn't I think of that one? And so it leverages my time tremendously already.
Mhm.
But
100%.
but the issue that's overlooked by the stock market, same as in the dot-com bubble, is the leaders of today might not be the leaders 5 or 10 years from now. And the change that they're advocating and expecting to rock our world will happen a little slower than the narrative. And if that's correct, this is a bubble. And whoever coined the expression Magnificent Seven didn't see the movie. 4 of the 7 are dead at the end of the movie. So, which are the 3 members of the Mag 7 that'll be dominant players 10 years from now? I don't know, but it won't be 7 of them.
Time will say. All right, so we're getting close to the end of the conversation. I have one last question, although I think I know what you're gonna say, but I always like to wrap up my chats with this one, which is if you had to give a piece of advice for our listeners, particularly the younger ones that are entering the finance industry now, what would you tell them? What would a piece of advice be to have a successful career in finance, as successful as yours?
I would say, um, firstly, life is an adventure. Life is a roller coaster. You'll have highs and lows. Early in my career, when things didn't go the way I wanted them to go, I would wonder, what did I do wrong? Why is this going haywire? Why is this not working? And in time, I learned to just roll with it, accept it, and learn from the dips in the roller coaster. The second piece of advice is stay curious. Always think of everything you encounter as a wonderful gift, a learning experience.
I knew you were going to say that one. Curiosity. That's the word I had in mind. And it's not the first time one of my guests brings it up. And with that, Rob, it's a wrap. Thank you so much for taking the time of speaking with us. I found this conversation incredibly interesting. Thank you for all the things you've done for the finance industry, for your contributions. And I really look forward to reading your paper on why stimulus is not stimulative.
Thank you. And anyone in the audience who wants to look it up on SSRN, feel free to reach out with any suggestions or questions or comments.
Thank you very much. The Blunt Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production, comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blunt Dollar for more raw, honest finance conversations.